Over the past 4 decades, private equity has evolved from a niche financial strategy into an $8 trillion global asset class. This tide of capital now shapes modern employment, market competition, and corporate governance. A relentless influx of institutional capital from pension funds and endowments now outpaces the availability of quality companies to buy. This chart shows U.S. private equity capital formation, with fresh capital nearly doubling between 2016 and the 2021 peak. The orange line represents dry powder, unspent capital committed by investors. The industry entered 2024 with over $914 billion in unspent cash. This backlog of unallocated capital forces funds to pursue increasingly massive megadeals to move their cash, raising the stakes of their investments for the broader economy. The industry markets itself as a superior alternative to public markets, claiming that private equity partners generate higher returns through active, high-precision operational management. The mechanical reality of a leveraged buyout, or LBO, centers almost entirely on the aggressive use of corporate debt. When applied at scale, this debt model produces two divergent outcomes, depending on the specific sector being targeted. In one scenario, the pressure of debt drives genuine operational efficiency. In another, it acts as a mechanism for extracting value from fragile companies, leading to bankruptcy. This investigation examines whether the LBO debt model functions as a legitimate tool for fixing broken firms or an asymmetrical extraction method that undermines long-term economic stability. Evaluating private equity requires moving past the industry's preferred metric, internal rate of return, and instead using the public market equivalent. This academic standard compares buyout returns directly to what an investor would have earned in a public index like the S&P 500. This chart shows buyout performance shifting over 40 years. Funds between 1984 and 2005 delivered significant outperformance, beating the S&P 500 by over 20%. From 2006 onward, the public market equivalent dropped to 1.0, effectively tracking public markets net of fees. If actual cash returned have normalized, it raises a question: how do funds continue to report double-digit IRRs to their investors? The discrepancy often stems from the aggressive use of subscription lines of credit. Instead of calling for investor cash immediately, firms use short-term bank loans to fund the initial purchase. Because IRR is a time-weighted calculation, delaying the capital call shrinks the time denominator, artificially inflating reported returns by hundreds of basis points without creating underlying economic value. Firms further stabilize their numbers through volatility laundering. Since these assets are private, managers value them internally rather than against daily market prices, smoothing out apparent risk during market downturns. The industry's growth relies increasingly on accounting maneuvers and metric manipulation, rather than market-beating operational success. To understand why the LBO model succeeds in some sectors and fails in others, we have to look at the balance sheet of the acquired company. In a typical buyout, the private equity fund provides an equity check for roughly 30% of the purchase price, borrowing the rest. Crucially, this massive debt is placed directly on the acquired company's books, forcing it to use daily operating revenue to pay the interest. Proponents argue this debt burden is a positive forcing function, aligning interests of managers and owners. Under this theory, the constant pressure of interest payments prevents corporate executives from wasting free cash flow on inefficient projects or bloated administrative costs. Empirical data from the Census Bureau suggests this model works as intended in capital-intensive industrial sectors. In these environments, researchers have documented measurable productivity gains and better capital allocation. In some cases, workplace injury rates and safety violations actually fall as managers rationalize operations and focus on core competencies. In asset-heavy industries with clear operational bloat, the LBO debt model successfully drives necessary efficiency. The outcome changes entirely when extreme leverage is applied to thinner, more vulnerable sectors like retail. This chart compares the 10-year bankruptcy probability for buyout targets against similar firms that remained public. The data shows a 20% probability of bankruptcy for private equity-backed firms, a 10-fold increase in the risk of financial distress. Mechanical failures in the retail sector illustrate why this risk is so high. Many firms utilize a sale-leaseback strategy. They acquire a retailer and sell the physical buildings instantly to recoup their investment, then force the retailer to sign long-term leases on properties previously owned. This leaves the retailer burdened by new rent obligations and high interest payments, while simultaneously stripping away the real estate collateral that would otherwise provide a safety net. In retail, this high-leverage model extracts the company's foundation, leaving the firm hollowed out and prone to collapse from minor shifts in the economy. The consequences of value extraction become a matter of public safety when the model is applied to essential services like healthcare and nursing homes. Because the acquisition debt demands immediate cash flow, facilities often cut clinical staffing hours. One NBER study found that private equity ownership of nursing homes correlates with a 10% increase in patient mortality. To maintain solvency under their deadloads, these firms must also secure higher prices through a process known as stealth consolidation. This is a roll-up strategy. A firm buys a platform clinic and absorbs smaller competitors until controlling a regional monopoly. These acquisitions fall below reporting thresholds, allowing firms to build massive local market share completely undetected by federal regulators. This chart shows pricing power gained through roll-ups. Once a specialty is consolidated, firms can force insurers to pay significantly higher reimbursement rates. In anesthesiology, post-acquisition prices surge by an average of 16 to 26% once a firm commands dominant market share. In essential services, extreme leverage extracts value directly from patient care and consumer wallets to service the interest on debt used to buy the clinics. Metric inflation, real estate stripping, and stealth consolidation now operate as standardized structural mechanisms across nearly half of the private market. Capital is increasingly concentrated at the top. Nearly half of all capital deployed today is locked in mega deals exceeding $1 billion, controlled by a small group of multi-trillion-dollar platforms. This scale, combined with the industry's lack of transparency and its reliance on private credit lending, has created significant unmapped risks for the global economy. Central banks are now investigating whether this interwoven debt constitutes a systemic threat. They are concerned that a wave of defaults in private equity-backed firms could destabilize traditional banking networks. Yet in the United States, regulators have been blocked from requiring even basic fee transparency. A federal appeals court recently vacated SEC rules that would have opened the industry's books to its own investors. The structural opacity of private equity, shielded from both antitrust and financial oversight, has become a massive macroeconomic liability. Evaluating private equity requires looking past marketed performance figures and focusing on the mechanical burden placed on acquired companies. The LBO model creates a bifurcated economy. It successfully rationalizes bloated industrial sectors, but it ruthlessly strips value from the labor and consumers within healthcare and retail. The leveraged buyout functions as a high-leverage extraction tool. Its societal outcome determined entirely by whether the target is a bloated factory or a fragile nursing home.